This episode of the Planet MicroCap Podcast is brought to you by Friedman LLP, a top 40 global accounting, tax, and business consulting and advisory firm, providing a full spectrum of services for public and private companies since 1924. Contact Friedman when you will need to raise capital and adhere to U.S. standards. The Friedman partners will work diligently with you to provide the financial assurance, regulatory, and transactional services you need. When the stakes are highest, Friedman makes sure you are well equipped. For more information and to get a Friedman free consultation, please call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com. Again, for more information and a free consultation, call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.
Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And you're listening to episode 166. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@SNNWire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the microcap message. Save the date. The Planet MicroCap Showcase Virtual is coming up fast and furious. It's happening April 20 through 22nd, 2021. The website is live. And not only is the website live, we have our initial speaker sponsors and our presenting company. So go and check that out at www.planetmicrocapshowcase.com. We've added a few more speakers that are signing up, and we'll have the full agenda. I'll be announcing that relatively soon with some of the new panels and keynotes that we'll be doing. So registration is open. Go register on the website. Click the register button. Very simple, very easy. I look forward to seeing you all there. Again, the website is www.planetmicrocapshowcase.com. This week from the SNN Podcast Network, we have new episodes of In the Market Trenches with Gary Reeby and Eric Fury, the Investors Roundtable, and Avoiding the Crowd with Maj Sway Dunn, all coming at you this week. You can check out all the new episodes on Apple, Spotify, YouTube, or Podbean, or wherever you stream podcasts, and catch the video chats on the SNN.Network YouTube channel at youtube.com/SNNWire. Now, for this episode of the Planet MicroCap Podcast, I spoke with Jim Royal. He is the author of the new book titled The Zen of Thrift Conversions, How to Turn Hidden Bank Stocks into Big Gains. Jim and his book were recommended by one of our listeners. Thank you, Gunnar. And I'm so stoked that he was. I never even heard of thrift conversions before this conversation. And that's saying a lot living in the obscure microcap land that we do. That's why this episode is the 101 class version. And I think I might be able to tell you what a thrift conversion is now, let alone spell it. Jim does a great job detailing this asset class. And as an awesome bonus, he was a contestant on Jeopardy, so we chat about his experience there as well. So come for thrift conversions, leave with a great story about Jeopardy. Thank you again for tuning in to episode 166 of the Planet MicroCap Podcast, and please enjoy my interview with Jim Royal. Welcome Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me right now, my special guest on the program is Jim Royal. He is the author of the book, The Zen of Thrift Conversions, How to Turn Hidden Bank Stocks into Big Gains. We are going to learn all about it today. We're going to do Thrift Conversions for Dummies episode today. So, Jim, thank you for joining me, man. How you doing?
Thanks for having me.
It's great to have you on. So this is our first time meeting. Where are you based? Are you
I'm
in a library somewhere or what? Yeah,
yeah, it's quite a few books in the background, right? So I'm actually based in St. Louis and work from home normally as a reporter for Bankrate. And so the book actually came out of some my history as being an investor in special situations when I worked for the Motley Fool. So a lot of my experience and professional backgrounds from there.
Oh, so you're part of the Motley Fool machine. I swear. It's like every other guest I have on here is like, when I did my time at the Motley Fool, writing on this or that thing. So, what was that experience like? Clearly, it set you up for writing a book on one of the most niche special situations out there.
Yeah. So, no, it's great. I think the Motley Fool does a great job about teaching its analysts how to look at businesses, focusing on the important issues and, and not getting bogged down in some of the minutia. And so thinking big picture and being generalists, and I think that helps. So when I was there, I was an analyst for them and investigated special situations, including, of course, thrift conversions, as well as spinoffs. And so that's some of my background. And in the book, for example, I talk about a lot of investments that I actually made personally or professionally when I was working there. So it was a great environment for just encouraging critical thought and helping you develop skill, right? And really taking an approach where you could just investigate, right? You could investigate anything. So that's a great sort of open mindset.
Absolutely. No, I'm gonna have to at some point. I'm gonna get the founders on here to talk about the machine because it's really incredible how they've been able to just create this machine for people to then splinter out and do stuff like what you're doing and so many others that have come on the show. So
yeah, Tom and David are fantastic.
They're awesome. And so one other thing I have to touch on before we get into your background and everything like that. I know you just touched on this briefly in the interview you just did with Toby, but Jeopardy is one of my favorite shows. I got it on at 7:00 every day. I like to think I'll be a contestant one day, but then I know I'm going to run into the likes of you and get completely smoked. So, give us a little bit. How's the experience? What was it like?
If it's all about pop music, I think you could beat me. I don't know. It was a fantastic experience, and of course, I'm just referencing how I blew out on a basically a true daily double toward the end of the second Jeopardy round, and as basically the move I had to make in order to catch first place. And I missed this question about Adele, and so of course I have to joke about it and make fun of it whenever I can later on. But yeah, no, absolutely fantastic experience. I'd wanted to be on there since I was a kid. And so I finally, meeting Alex Trebek and just being on the show. And, even when I'm on there, and I take that daily double, and I'm like, Alex, I've been waiting 30 years to say, let's make it a true daily double. And that was absolutely the position to say it, the time to say it. And unfortunately, it was a good wager sort of structurally, right? It's what I had to do at that moment to try to get into first place. And unfortunately, it just didn't work out, right? But it was an absolutely total blast. I got to see a full week's worth of filming, and I just can't say enough. They run just a really professional shop there, the showrunners, and just it was just a blast all the way through. So dream come true, really.
Absolutely. Well, here we're going to stay on this train because, as a fellow Jeopardy fan, it seems like the strategy has changed so much since Ken obviously was the first man, and then James with how he was able to accumulate so much money and go on that run in a much shorter period of time. Mm-hmm. I mean, look, we're about to do like some like Jeopardy gameplay with parallels to investing. Don't worry, we're going to get to the book, but I mean, we got to stay on this. So, sure. I mean, how has that strategy changed? And did you try and do some of that James-like strategy when you got on there?
Yeah, I mean, I think a lot of my background, like the interesting thing about Jeopardy or other similar types of games, I'm also a member of an online trivia group called Learned League, which has tens of thousands of people. Ken Jennings has been, I'm not sure if he's currently registered, but he has been in that league. And it's great because there's the game element, the betting element, and the actual knowledge element, right? And so like if you're smart, you can use that betting element to leverage that knowledge, right? So, and I think one of the things I wanted to go in strategy-wise going into the game was say, hey, look, you can beat me on knowledge, but I don't want you to beat me on the game playing aspects, the wagering aspects, right, of the game. And literally that first day, I saw a contestant lose merely because she placed the wrong bet in Final Jeopardy, right? And so there's situations in which, you know, you got your number one, number two contestant really close, right? Both of those contestants have to basically wager it all. And if they end up missing, the only way in third place you can win is if they both end up missing. So you wager based on that outcome, right? And which means you basically wager nothing. And so she missed being a champion just because of the wagering element, right? And so that was the type of move I wanted to make sure that I didn't, you know, screw up on. And, you know, going for it all on that daily double was absolutely the right move. You don't play for second place, right? You play for first place. And that was what I needed to do to play the game right at that moment, even though it simply didn't work out because of the knowledge.
Right. Well, you know, the other day, I don't know if you watched this episode where I was watching it live, and the two contestants, I think, were both at like 14,200, and then third place, she was at 2,000. And what they both did, which was the right move, no doubt, was they both went all in because let's say even if they both went all in, but then the 2,001 put in zero because she knew that the other two had to go all in. And that was the only shot that she had at winning the game. Of course, they both got it wrong, or all three got it wrong, and she ended up winning the game with 2,000. It was incredible.
That's exactly what I'm talking about, right? You want to go in with the right betting strategy. You know, if you're in that situation, if you're third place, you can't even bet enough to get ahead of either of those. So you play off the strategy and you hope, and that's how you win, right? When I was on there, I was like desperately trying to get that daily double. Like, this is my chance. And, you know, unfortunately, it was in female singers mononymous. So one name female singers, which is really must be my worst category. And steel companies. And I'm like, please let the daily double be on the steel companies category. But it wasn't.
So I mean, have you been listening to Adele nonstop just to try and work through the grief? Or how did we do this? Like that's how you got to process it somehow.
Yeah, every once in a while, it kind of comes back to me. It's like, man, I just
someone like you. Oh,
right. No. Eventually, she's going to stumble onto my tweet, right, where I say, "If only I had known someone like you," and that's going to eventually get out there, and she'll reply, and it'll be a big joke. So
that's too funny. Well, so
by the way, just quick, like, you know, one of the things I framed when I was going out there was like, this is a call option, right? I'm not paying any money to come out here. It's a call. Maybe I go and win $50,000 or $100,000 or more, whatever, right? It's a no cost call option to me.
Yep. Yeah, no, I mean that sounds like especially if you're on the first game before you're, you know, next day champion, right? Because at that point you have something to lose, right? Like now, or at least that feeling that, all right, well, I could keep getting more money. Like I won yesterday, I could win again. Oh no, I don't. You play not to lose. Meanwhile, when that first time, it feels like you play more to win, and you kind of have that like, hey, it's gravy, baby. Like whatever happens, happens. Like let's just do my best. So it's interesting, that mentality going into that game. And I mean, similar with I mean, let's go here. I mean, what are some parallels that you had when you think about your investing career and everything that you learned in the Motley Fool? Like, what are there any parallels into Jeopardy gameplay or just trivia gameplay and investing that you've been able to use in your career?
I mean, I think absolutely the best one is, thinking about free call options, right? Where do I have really low downside and some medium, maybe even large upside, right? At little cost, right? So, as I'm talking about, like, well, going on Jeopardy is a free call option, right? They're going to pay me, regardless of how I do, they're going to pay me $1,000 to get out there. I'll have some fun in LA, get to have a dream come true, realize a childhood dream, meeting Alice Trebek, being on the show. Like, how can I lose? I just can't lose on that. And so that's one model I think about often in investing, right? There's very little downside. I think thrifts, this carries over very, very well. You're buying thrifts at a discount to tangible book value. So your downside is tremendously low. You've got good, sometimes great upside for 3 to 5 years on individual positions, and that's the type of thing where you bet heavy, right? When you've got low downside, a track record in this space of doing really well. That's to me a great setup for good returns with low risk.
Very cool. All right. I promise, like, I have one question in between, and then we're getting into thrift. Sure. So I'd love to get more of your background. Where did your passion for investing begin? And that'll take us to thrift.
Yeah. So I think
I'll probably have another follow-up, and everyone's going, just ask the damn thrift conversions question. But love to hear where your passion.
Yeah. So I think probably like a lot of boys growing up, it was like baseball cards, right? It was like, hey, look, you got it was super easy. You see, hey, look, this is worth $1. This card's worth $1. This card's worth $2, right?
The Beckett books, everything. Yep.
Yeah, absolutely, right. And so you're opening the wax packs or whatever, and it sort of started for me there, but then tying it to, this guy is like on fire this month, right? He's hit 10 home runs, right? And his baseball card goes up, right? So you can sort of, in a certain way, tie it to fundamental performance, of the player, right? Like you can with a stock. Or, I was like the nerdy kid who was like, wait, if these commons are worth 5 cents each, and I buy a pack for 35 cents, then I'm really getting, 75 cents worth of cards, right? So I'm like doing this, really simple arbitrage in my head about buying wax packs, as a 10-year-old or something like that. And so probably got to the start there. But then, I did economics stock picking classes in high school and stuff like that. I got a stock that was like a 4-bagger in a semester. I was like, wow, this is great. Just great to follow the market and fun and interesting and, a way to make money and have that sort of intellectual stimulation or challenge.
Very cool. All right. So, and by the way, how lucky that you actually had a stock picking class in high school, right? Like, wish everybody could have that experience. I had it in 5th grade, but I still even think that, like, I wish that continued on in every grade. But yeah, I mean, it's pretty amazing. So, I mean, so catch us up. You mentioned that you worked for the Motley Fool. So catch us up to where you got the desire and inspiration to then write the book.
Yeah, so it was really, I'd probably been investing, I think, 10 years or something before I had ever heard of thrift conversions, right? And it's like super easy to overlook. I was investing in special situations when I worked for the Fool, and I'm just investigating different types and sort of stumbled onto thrift conversions. And it's like, this is really interesting. This is circa right after the financial crisis, right? 2009, 2010. And I'm just reading about thrift conversions, low downside. I'm reading Joe Stilwell in a Wall Street Journal piece. And he's talking about being an activist and how cheap they are. And I was like, this is a great setup. These sort of small, out of the way banks that nobody's heard of, and at low prices with potential buyouts, a history of being bought out at premiums to book value. And it's just a lot of good stuff, and activists to help you realize that value too, right? So it's just lots of really cool elements there. And I thought, it took me 10 years of looking at the market before I had sort of heard of these. And, because the media so often just focuses on the big names, right? Like the big cap stocks, the big IPOs. And it's just easy to miss these smaller things, which just sort of fly under the radar. So I just thought that was such a cool thing. I invested in them, had good results. And I thought it was just how about we write a book? How about I write a book that explains how these work, how they operate? There's literally no book that sort of runs you through the whole life cycle of these, how to invest in them at every stage, what to look out for, what to watch. It's all based on, my personal experience of investing in them. And it's really, I heard somebody call it a crash course in how to, invest in thrift conversions, right? And so I think that's a really appropriate way. But so I write this for a beginner or intermediate audience. But I think that there's something that everybody can get out of it with the interviews. If you're familiar with banks and things like that, I have interviews at the back of the book with the three big activists in the thrift conversion space: Joe Stilwell, Larry Seidman, and Rich Lashley. And they talk about how they view banks and how they invest. And so I think it's just a great cap, because those guys are so vital in the thrift industry, right? I don't think there's another industry that is so dominated by activist investors as thrifts are. And it's great if you're a minority shareholder in those. So anyway, okay. Roundabout
All
answer.
Right. Oh, no, we're good. Now I think we're ready for the thrift conversions question. Now, as I said at the open, this is going to be the Thrift Conversions for Dummies episode. So for those who actually know what they are, this is probably going to be the part where you're going to be like, all right, okay, get to the meat, for me. But so thrift conversions for dummies, what are they? And maybe can you give us an example?
Sure. So yeah, whenever talk about thrift conversions, really what we're talking about is typically what's a pretty small community-oriented bank. And what distinguishes it here is that it's mutually owned, right? It's not a stock company. It's mutually owned and by its depositors. So if you have an account with the bank, you really kind of own a stake in that bank. And that really doesn't mean very much until you can't go in and say, hey, this is my slice of tangible book value and I want it, right? You can't really do anything about that until the bank decides to do an IPO. And then you basically get first crack at taking a stake in that business, right? So you are given the right to buy stock in the IPO ahead with more preference than anybody else, right? And so it's a great opportunity. And it's a great opportunity because basically you've got all this tangible book value, all this book value equity that's sitting in the bank that in a real sense, nobody has an economic claim on, right? So when you buy into that bank, you effectively get a share of that for no extra cost, right? So your money in it, unlike in a traditional IPO, right? Where a buyer in that IPO, that money might be going to, the buyer's money might be going to somebody who's looking to cash out. It might actually go to the company. It might go in multiple different ways. And so there's some misalignment of incentives. Like, if this is such a great deal, why are these people selling this stock to me? And why should I be buying? And so in contrast to that, with like a thrift IPO, you've got everybody sitting on the same side of the table, buying in at the same terms, right? And even the bank is not selling it to you exactly, right? The bank is not cashing out, right? All that money that they raise in the IPO goes straight into the bank. And you get a piece of that equity completely free on top of that, right? So you're investing alongside with the same incentives as managers and insiders. And that's a great setup. This is actually one of the things Seth Klarman really points out, is this alignment of incentives that really distinguishes the Thrift IPO from any other IPO, or basically any other IPO. And so that's a great setup. So I think in big terms, that's what a thrift conversion is. It's moving from this mutual form of ownership to a stock-based form of ownership. And a lot of these banks are 30, 40, $50 million market caps, really pretty small communities. They operate in one or two or have just a handful of branches. There's no way you would have heard of them, basically.
So here's my first dumb follow-up question. So maybe we need a quick background on what is the traditional ownership structure look like for these community banks, just to get a better idea of, going from this mutual form to then a stock form of ownership. What does that look like? Yeah,
so the bank is managed, right? Somebody's managing it and somebody holds that, but it literally is mutually owned. That doesn't, if you're a depositor, that doesn't mean anything in terms of your ability to access any capital in that bank, right? You don't even have an economic claim on that bank. And in fact, really nobody has an economic claim on as an owner on that bank. Sometimes they're structured, there might be a mutual holding company that technically owns the banking operations, or the bank that actually does the loans, but there's no actual owner of that capital, and that's what's striking, right? And that's what helps create the opportunity. There's always a sort of because of that structure. If I put up money, there's always going to be something in excess that's given back, right? So you basically by design have to get something more than you've put in. And so that's part of the really interesting structure, and of course, when it goes public, then it's a stock form of organization and the shareholders legally own that capital, at least en masse.
Got it. So then who gets, you mentioned, sorry, but I wanted a little clarification. Sure. So then who gets access to the actual IPOs? It's anybody that pretty much deposited money in that bank now has access to
basically it? That's it, right? There sometimes you'll get a few little I would say 95% of the time it's the depositors. Sometimes the borrowers every once in a while get some access, but it's usually almost only depositors and the employees, directors of the bank. And that's having a deposit account is what entitles you. It's like a subscription right? You have the right to participate in the offering, in the IPO. Sort of by design, these typically go off at $10 a share, and that money goes straight to the bank and basically recapitalizes the bank.
Got it. All right. So why is it then called a thrift conversion? I get the conversion part, right? Yeah. But why is it a thrift conversion? Because you're basically getting it cheap, or you think thrift, you think cheap, right? So that's right.
So thrift is just a sort of old line term for a savings and loan or a mutual. It would sort of be a little more accurate to say mutual conversion, which is really another very typical term for these. And so the thrift is also, a common term for them, and so that's where it comes from. Just sort of an old timey word for a small bank, small savings and loan.
Got it. Okay, so then the upside is when, from an investor's perspective, is okay. I want to invest in this IPO because I know that we all are getting all of our incentives are going to be completely aligned, and it seems like it's much easier for an activist or activist investors, or let's say one activist investor, to pool a lot more money in order to make sure that the company, after it goes public, is being run in a way so that it's friendly to shareholders. And that is that really the thought process there?
Yeah, I think that's a lot. The activist investors here tend to focus on the banks that are not particularly well run, where they're the real, they tend to be the real catalyst. And of course, on the banks that aren't well run, they tend to trade at cheaper valuations. And often when these banks come public, they have often mediocre at best corporate governance. You've got directors on the board who have never served on any other public board. They tend to be sort of local business leaders, and buddies of the managers of the bank. And so you definitely have some governance issues here when these things go public. And activism or activists help sort of counterbalance that. And that's a real important dynamic here. An activist can typically take no more than a 10% stake, but often that's a really huge stake, or has a huge outsized impact, especially if they can get a person or two on the board and help sort of shake up the board and get things moving if it's stalled or not taking action on shareholders' best interest.
Got it. All right. So, where have you found the most success when looking at these opportunities? Is it after they've been public for a while and, maybe it was a great deal at first and now it's quote unquote a fallen angel? Or is it better to look at it at the IPO and with fresh investor, the activist group and when's kind of the right time? I know there's no right or wrong answer here, right? But curious your thoughts.
So I think the way to think about this is think about a typical model for thrift conversions, right? And so a typical life cycle here would be you go public. A year after that, you can buy back stock, repurchase your own stock. And if it's trading, as many of these are, maybe most of these are, at a discount, sometimes a really substantial discount to tangible book value, then you get immediate accretion, right? Immediate gain in tangible book value per share by buying back at a discount. And that's after year one. And then after year three, you can be acquired, right? And it's not unusual for a big chunk of these banks to be acquired in between that year 3 and year 4 period, and then year 4 to year 5 is another big takeout period. So a lot of these banks are acquired about 5 years after they go public, and at least over time, about 70% of banks of these thrift conversions have been acquired.
Wow.
And typically, at least on average, it's been about 140%, not quite 140% of tangible book value. That's been trending down a little bit over time as rates have fallen and whatnot. So that's a sort of typical life cycle of one of these. And sorry, to get back to your original question. So it's just important to sort of understand how those might play out. And sorry, could you refresh me on the question, please?
Yeah, no worries. Yeah, look, sorry, I this is honestly because I didn't. Full disclosure, I didn't read the book, but so that's why I'm going dumb question one after the other. But you're talking about the question that you before. Oh, in your experience, do people tend to invest in these, after it's already gone public, and then?
Right.
And then, or do they tend to look at it like professionals like you that look at these on a constant basis? Do you look at the IPO?
Right. So I think multiple things. Part was you look at that life cycle, that sort of really typical life cycle, and then you think, where can I fit in? A lot of people are going to invest with that model in mind, right? I'm going to buy relatively early on at a discount, and then just ride through each of those checkpoints. Until maybe we get a buyout in a 3 to 5 year period. That's one model. Some of these have been kicking around for 10, 12, 15, sometimes 20 years. And, that model, if you're betting on a 15-year-old one to get bought out, it might happen, but it also helps if you've got an activist in there pushing and things like that, right? But a lot of these, as I say, typically are bought out in the 3 to 5 year time period. And that's a lot of the model, right? So you invest early or invest at a discount and continue to hold on until you see that appreciation, right? Of course, banks aren't stellar earners here. And a lot of these banks are making 2, 3, 5% returns on equity, which is not stellar. You're not going to retire rich on that. You're going to retire rich on the multiple expansion, right? And so, fine, you get a little extra juice from the ROE, growth in book value, but it's really multiple expansion that drives your returns here.
So why is the ultimate exit more often than not an acquisition of these, rather than just continuing to grow?
Yeah, so I think that really lies in the fact that these banks are small. They've got no scale. They will never have scale. And the economics just aren't there for them really to make acceptable returns on equity, right? I think in general, if you see a thrift making 7% returns on equity, that's really pretty good. And it usually has to be, let's say, more than $1 billion in assets or something like that to be able to do that. A lot of these thrifts are not especially well run, even still. There's technological issues, that sort of constant investment in technology that's needed to keep these small banks in business. The legal costs, right? And it's like you'd much prefer to spread that out across a bigger asset base, or just basically plug that into somebody else's distribution and management sort of network or technology platform. And that's going to end up being much more advantageous for everybody. And that's the real value add here or that's the real way to make the money here, right? You would never otherwise pay 1.2 times tangible book for a bank that's earning 2% return on equity, right? It's all the cost savings that can be taken out of the business, all the management that can be stripped out, and all those other costs, right? And so, Rich Lashley is estimating that, you can take 50% of the cost out of these businesses, right? So that's really significant cost savings. And so the economics of consolidation are just undeniable here, right? We've had, and just as a historical point, we had something like 40,000, financial institutions back in the mid 80s, and we're down to about 5,000. Wow. And maybe 450 of those are thrifts. So it's just going to keep coming. It's, we're going to have more of these. They're going to be consolidated and bought out. You just can't over time fight the economics, right?
Right. Well, that actually led to my next question, and I guess it pretty much answered it for me, because I'm thinking to myself, well, are all community banks that are public considered thrift conversions, or am I off there?
Yeah, so it's the ones that used to be mutually owned, and that's certainly not the case for many small banks. So some are community focused, right? Started by somebody in that local community, but that were not mutually owned. Okay. And so that would be a different setup if those guys went public, right? There's different sets of incentives than you would have for a typical mutual conversion, but you might sort of still have a similar end game in terms of these guys being bought out, the sort of non-mutuals being bought out because the economics simply aren't there.
Got it. All right. So then how do we separate the riff from the raff? What's the crap and what's the, all right, these are good. This is good criteria for potential investment in this.
Yes. So I tend to, I think the book, what I try to do in the book is really just give you, I have my sort of 9-step checklist, which is really just 9 things that you can look at really quickly to get a read on the business. And I sort of even further simplify that to just 3. Just as if I want to look in 1 minute or 2 minutes to figure out, is this worth even more time? Or, so I really go to the price you're paying. So the price relative to tangible book. Is that at a discount? How much upside could I have? And sort of what time frame I've got. So if you think a buyout maybe happens in a 4-year period, and I'm buying at 75% of tangible book value, and I expect upside to 120% of tangible book value, what do my annualized returns look like there? So thinking about price of tangible book, thinking about return on equity, I don't care about the level so much as I care about just consistently being profitable, right? You just can't expect great things out of these thrifts in terms of their fundamental performance. that's not where you get the juice here. You basically get it from them not blowing themselves up. And then finally, or insiders frittering the money away in some fashion. And then finally, equity to assets. So that gives you some idea about how safe, that gives you some measure of safety, right? If they're sitting at 8% equity to assets, they don't have a lot of room to maneuver and use their balance sheet to create value for investors via buybacks, right? It's less likely that you might have an activist come in because the activist can't force them to buy back stock with money, that they don't have. So higher equity assets gives them more ability to, makes them safer and gives them more ability to buy back stock, which is highly accretive at discounts to tangible book. So those are the sort of very first three things I look at to sort of get some read.
And where do you find these things? I mean, I know a lot of community banks, whether they're thrift conversions or not, are listed on OTC markets. But so are you just on OTC markets all day, just kind of seeing what's going on, or where do you go?
A lot of these are traded on the NASDAQ when they come public. And
interesting.
So sometimes they will, after a year or two, shift to OTC. Maybe that's a question of
just less listing fees, all that kind of stuff.
Right, exactly.
Yeah, I got you.
But a lot of them list on the NASDAQ when they go public, and I follow S1 filings to see what's coming out. And actually on the website, the Zen of Thrift Conversions.com, I list all of the upcoming, recent IPOs, upcoming IPOs, and usually when they file, it's 3, 4, 5 months before they actually go public. And then I've got, I list on the site all of the non-public banks, non-public mutuals, where if you live locally, you can go open a deposit if you want, right? So you can go to the site, figure out, hey, look, I live in New Jersey. I can go open an account at X, Y, and Z, and maybe I get to participate at one of these.
Have you done that at all? Oh, come on. I feel like you hey, dude, there's a mutual in Jersey. Like, here's $500. Open an account in my name. Let's go.
I have deposits in individual ones and individual banks. One of the things I stress in the book is that approach, sort of taking part in the IPO, is the one that gets played up a lot. You often get a first day pop of maybe 15-20%, which is attractive for sure, but you get a lot of gains over time in these. And so that first strategy is actually probably the hardest to implement. And it's easier actually to buy a stock that's already publicly traded. You don't have to tie your money up in the bank for, an indefinite period of time. And so that is you'll miss that first day pop by buying actually out on the exchange. But you often have plenty of time to buy. You can buy on your terms. You can take advantage. As we saw in 2020, banks just got hammered. So you can take advantage of that. I was out in late 2020 buying a bank that had gone public a little less than a year ago for 70% of tangible book value, waiting for, and it had a history of repurchases, right? So there's lots of opportunities out there by buying in the public space. And fine, you don't get that 20%, but you still have substantial upside, right? Let me point to just one, Eastern Bancorp, which I don't own shares in that, but it was highlighted in October when they went public. It was actually a quite humongous IPO, at least relative to these things. They raised about $1.8 billion. And that started out, it did about a 20% pop on its first day. And since then, it's gone from about $12 to about $18.50. So you could still enjoy a huge chunk, the majority of those returns just buying in the public space.
Absolutely. I was just going to ask you, because at the very top, what is a thrift conversion? And give me an example. So you just kind of mentioned one of them, but love to hear, a full example of one of these thrift conversions, and maybe one that you participated in, just to explain the experience.
Mm-hmm. Yeah, so let me point out Harbor One Bank Corp, and that's not one I've participated in directly, but it's actually a really unusual one. So the thing is, a lot of these thrift conversions can kind of go public in two different ways, right? They can just IPO all their stock at one time, or so that's what's called a standard or one-step conversion, and then alternatively they could do what's called, you might guess, the two-step conversion, and they sell part of their stock, a minority position in the bank, to the public, and then some years later they do the other part. And so that's the approach. This two-step conversion is what Harbor One did back in 2016, and actually they had converted from a credit union not long before that, and so they converted from a credit union. They did a first step. They did the first step of their conversion, I believe, in 2016. Then 3 years later, they came back, 2019, did the second step, sold the majority position in the bank to the public, and now they're fully public. And once you're fully public in this situation, it's 3 years until you're often buyout bait. And the stock is, they're coming up on year 2, I believe. And so not too much longer, year and a half or so more, and it might be sort of no holds barred on Harbor One.
And Jim, we're talking about the opportunities here and, flowery side of it. What's some of the downside risk in investing in some of these thrift conversions?
Yeah, so I think that's one of the things, that's one of the reasons you look at your valuation and you look at how much equity to assets they have, right? You typically don't look too closely. You don't have to worry too much. If the bank is consistently profitable and has decent loan metrics, you're not going to blow up the bank here. The real risk here, I think, is management doing something dumb with the cash that they've got, going out and making an acquisition, buying a bank at above tangible book value when their own stock trades at substantially below tangible book value, giving it away in compensation in some fashion or perks in some fashion. So that's a lot of the ways that this is going to blow up is through bad management moves. And you sort of guard against that by having a big chunk of equity and looking at the history and making sure that it's at least not being run too poorly. And and the ones that are the ones that do look sort of spotty, that's some of the value of having that activist in there that helps protect that downside, right? Because they're going to fight for things that are really going to help shareholders. And so there's some marginal banks that are, it's like, I would not invest in this except for the activist. And the activists just do not let go in this space. They do not let go.
All right. Well, I'd love to hear an investing experience in these things that you've had that you learn the most from, where you're like, okay, I thought I knew everything about thrift conversions, but that takes the cake right there.
Yeah,
and
so
that maybe set you up for the future.
Yeah. So I'll point out really one oddball one that I discuss pretty well at length in the book, and it's still out there. It's still publicly traded, and it's just so weird that it's TFS Financials, so TFSL. And I don't own stock in it, at least currently. I have owned stock in it. And it's in this weirdo. So I just described the sort of the the first step of a conversion and then the second step of the conversion. Well, these things trade publicly when they're in this kind of limbo state, right? And that's the situation that TFSL is in. And for many years, they went public in 2007, and for many years they really aggressively bought back stock. The stock was trading sometimes at 40% of partially converted tangible book value, and so they're out there buying it really aggressively. In some quarters they're literally buying back 4.5% of their publicly traded stock in a quarter, right? So like 1 year they went out and bought 16-70% of their stock in the year. And over like a 3-year period, I think they bought about 30% of their stock. But because of the way the reporting works under GAAP, that's virtually impossible to see. Because under GAAP, you're reporting these majority shares that are held by the mutual holding company. And I realize this is really kind of getting technical, but these majority shares that are held by the mutual holding company that haven't been sold to the public, that have no economic claim on the business, and are really, in a real sense, unissued shares, are being counted as part of the total share count. Right. So the company hasn't received any value, right, for that stock, and yet it's still sort of counted. So as you can quickly see, that really dings. That makes the market cap look really, really inflated when it isn't. It makes your earnings per share look much, much less. And so that it helps make a bank like that look invisible, right? For many years, it looked like it was trading at 250% of tangible book value. When it's actually trading at 50% of partially converted tangible book. And so there's just this weird disconnect. And so one final point I want to make on this is, so they bought back stock, lots of stock for years, and they paid a dividend. And guess who was entitled to this dividend? Only the publicly traded shareholders, right? The mutual holding company that held stock for on behalf of depositors would waive its dividend. So you'd have this bank where the only economic claim on it was the publicly traded shareholders. And so they would, around about 2014, they started a dividend, and then they would take out a huge chunk of stock, let's say 10% of stock, and then they'd raise their dividend. And then they'd take out more stock and raise their dividend, right? And so they started at, I don't even remember, 25, 30 cents a share, and then it's up to about $1.10 a share dividend on what at some points has been a $15 stock. And they're still only paying out, 60% of their earnings, right? So, but because of that weirdo structure, you can't see it. In fact, it looks like the bank is overpaying its dividend by 5x, right? It looks like there's no way this dividend is sustainable. And yet they're still significantly covered.
Man, this is as special situation as it gets, man. I'm like, I'm just so thankful you came on to explain some of this. I mean, a bit of that went over my head even a little bit. So if anybody's out there, don't worry, I'm with you. But but I recommend getting the book, because I think Jim does it. Again, I haven't read it, but if you go on his website and heard some of his interviews, he really does a good job at explaining how this all works and what the opportunity really is. So, I mean, Jim, for anybody listening to this that's maybe a new investor looking at thrift conversions, what's some advice that you would have for them?
I think the big thing is start small, and if this is the first time you're looking at individual banks, start small, or individual stocks, start small and work your way into it. These things, you really need patience. Despite the fact that we've seen a run up of 50% in some of these bank stocks in the last 3 or 4 months, they usually don't perform like that. It's small and steady over time, and low, and tends to be low risk. And it's just tremendously important that you make smart purchases on these, right? And by that I mean at discounts to what the bank is really worth, because you're not going to make it up in stellar earnings growth, right? And so you make your money on multiple expansion here, and that's just really vital to understand. And then the other aspect of that is thinking about what you might be able to sell, what the bank might sell for at some future and some future time frame, so you can come up with what might be a reasonable annualized return that you could make on these, right? And it's really striking. You think, well, an 80% discount to tangible book doesn't sound so like such an amazing discount, but if you think if the bank could go for 1.2, 1.3, maybe even 1.4 times tangible book in a 2 or 3 year period, you annualize that, and that is 20% plus returns, right? Or it could be 20% plus returns, and you have that low downside. It's just really important when you're a new investor in these, thinking about what types of annualized returns you can get and making sure you're buying smartly.
Very good. Well, listen, Jim, before I let you go, how does it feel being a Royal in Cardinals town?
Being a
Royal in Cardinals town.
Oh yeah, no, it's I haven't gotten any flack for it. When I was growing up, I used to be a bat boy, and
oh, that's awesome.
For during spring training and for the Dodgers in my hometown, and so was just always loved baseball, and of course baseball cards. And it's fun to now live in a city with a winning tradition, sort of. I've only been here a couple of years now, but it's been a fun place.
Hey, last year was a great year to be a Dodgers fan. I mean, to be any LA sports fan, that's for sure. One last question. What was the most valuable baseball card that you had when you were a kid?
When I was a kid, probably that iconic Ken Griffey Jr. card, that #1 card on the Upper Deck. That was the inaugural year of the Upper Deck cards, 1989, and Ken Griffey was the very first card in there. Yeah, so probably that one.
Wow, that's a nice card. I got a Derek Jeter rookie card. I think it's a Topps one, and I'm Jeter guy. What can I say? But I have all my stuff in a storage bin somewhere. So I think it's probably about time to dig some of that out. But with that, Jim, where can my audience go and find everything they want to know about you, follow you on social media, and also to buy the book?
Yeah, so the Zen of Thrift Conversions.com has it all. We've got links to buy, as well as I mentioned before, recent IPOs, recent conversions, links to the prospectuses, so you can get right into the details if you want, timelines, and then of course any thrifts that might be in your area where you want to be a depositor, right, and see if you can get in on one of these IPOs from the ground floor, and then otherwise just you can subscribe there or follow me on Twitter, Jim Royal PhD, on Twitter. So yeah.
Awesome. Jim, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. I look forward to our next chat.
Yeah, likewise. Thanks so much.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.
This episode of the Planet MicroCap Podcast is brought to you by Friedman LLP, a top 40 global accounting, tax, and business consulting and advisory firm, providing a full spectrum of services for public and private companies since 1924. Contact Friedman when you will need to raise capital and adhere to U.S. standards. The Friedman partners will work diligently with you to provide the financial assurance, regulatory, and transactional services you need. When the stakes are highest, Friedman makes sure you are well equipped. For more information and to get a Friedman free consultation, please call 856-830-1660 or email Neil Levine at NLEVINE@friedmanllp.com. Again, for more information and a free consultation, call 856-830-1660 or email Neil Levine at NLEVINE@friedmanllp.com.